Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Peak Prosperity Podcast. It is February 13th, 2018, which is, it just so happens, my mother's 80th birthday. So quick happy birthday to you, Mom. I never do personal shout-outs, but 80. Wow, congratulations. Hi, I'm your host, Chris Martenson, and today we're going to be talking about technology, the future, and whether or not these markets are a dangerous illusion, as I've been saying for a long time. Now, connecting these dots for us today is Fred Hickey, editor of the influential investment newsletter, the High-Tech Strategist, one of the most subscribed newsletters of its kind. Fred is a regular guest on Bloomberg News, is highly sought after for his opinions on technology and gold stock investments. Welcome to the program, Fred.
Thank you very much. Glad to be here.
Fred, I want to cover three big areas with you today as best we can. That would be technology, of course, these markets generally, and then gold specifically. To begin, Fred, how long have you been writing the High-Tech Strategist, and what's the approach you take in each of your monthly issues?
I've been writing it now since 1987, so that means we're in our 31st year. The approach I take is I think you have to consider all variables. I learned that early on in life. And so I start with a big macro view, top-down view, and then I work my way down to the specific areas. From the first 20 plus years, it was nothing but technology in the very micro area. But beginning in early 2000s, when I realized the central bank wasn't going to stop defending markets, and I thought that the gold bull markets, after a 20-year bear market, were likely to go into a bull market as a result of that, I then moved into the miners as well and the precious metals. And I've been there since because obviously, while I was trying to protect myself from what the central banks were doing, it was hard to envision back then for sure that we'd end up with a balance sheet of $4.5 trillion and central banks all over the world following the Fed's lead. So I do a mixture of both technology and gold right now. Ultimately, if we ever, our government and our central banks ever go back to the right path, then I hope to be able to drop the gold part of it. But for now, I'm in both.
Yeah, I have remarkably similar views on that. I'm not able to back out of gold at this point because of what we'll talk about in a little while with the central bank printing. They continue. It's not just the Federal Reserve we have to watch in these global markets. But before we go there, Fred, you focus on technology a lot. Tell us, where are the bright spots right now where people might be looking, or where you pin some hopes for actual economic improvements and serious quality of life enhancements? Where are you focusing now?
Well, I have to preface this by saying this is one of the most dangerous moments that we've had as technology investors. You know, I'd liken it right up there with the 2000 bubble, and I wasn't buying anything at the 2000 bubble top. In fact, I was shorting sort of put options at the time. And this is a similar kind of thing where valuations are crazy in the markets. You had the retail investors pour in, particularly into tech stocks and FANG stocks. So I think everyone knows the Facebook, Amazon, Netflix, and Google. They poured into those. By January, we had record inflows into those funds, the ETFs, many of them with the heaviest positions in the FANG stocks, driving prices up to crazy levels. You have the Amazons at multi-hundred PEs and some stocks like Tesla and Netflix not having any PE because there's no E at all. So it's pretty crazy. And as a result, I'm extremely cautious. In the 1990s, I was in long tech stocks up until late 1998, and then I got out. Then I started to move into the put options. I'm in more put options now than long the tech area. Although after last week's jump in the VIX to near 50. That forced my hand. The premiums went so high, I had to close out all of those positions, almost all of them. So I'm kind of flat with no positions right now. Now, if we look at where the growth is, I can tell you it's not in smartphones, which was the strong area in recent years. We saw this last month, the last quarter, I should say, fourth quarter numbers actually drop year over year, a pretty staggering 9% year-over-year decline in unit sales, and that was led by a 14% decline in China. It's not PC sales, which have dropped 6 years in a row. It's not tablet sales. So there are some areas of strength. It's not wireline or wireless equipment either. That's in decline. The areas where we still have strength are cloud computing. That would be one of the biggest areas now, where there's great capacity additions going on. Oracle just announced yesterday they were going to triple their capacity. They're going to add 12 data centers. That's a big area where Amazon, Facebook, Microsoft, they're all investing. Eventually, I mean, there's a lot of people that are working on autonomous cars. That'll be an area of interest in the future, but we're really not there. They're still testing. That's a 2020 and on kind of thing. 3D printing is out of favor, but that's still an important new market emerging. But like I said, this is not a great time to be investing. This is a time to be more defensive.
All right, I understand that, certainly, and I want to talk maybe specifically about one of the things you mentioned in there, just to give people a flavor of this. Tesla. Hey, they were just rather hilariously, I thought, and you did as well based on your Twitter feed, described as having reported a narrower fourth quarter loss than expected. Love the spin on that. That was in the Wall Street Journal. And my criticism of Elon Musk, I'd love to get your views. Listen, brilliant guy. The criticism is he has apparently not surrounded himself with people who can constrain his unbridled visionary qualities long enough to actually get something across the stable profitability goal line. That's how I see it. I mean, look, he's building hyperloops, proposing getting to Mars, running a major electrical vehicle company. He's got a space company. He's installing grid scale batteries in Australia. He's launching a solar roof tile thing, and now proposing, just yesterday I saw 30-minute rocket rides between global cities. That sounds like a visionary-itis to me. What are your views?
Mental telepathy, and also the latest thing, one of the latest and greatest, which were flamethrowers.
Flamethrowers, right? I love all of these, but collectively it feels like too much to me to really pull off. What are your views there?
Obviously, too much. This is, when the central banks go crazy the way they have, and they print money. And when you suppress interest rates, the price of money, when you make the price of money so cheap that there's no cost at all at 0%, it enables all sorts of crazy ideas. We've seen that in the past. In 2000, we had all kinds of .com companies that were doing crazy things as well. When anybody can borrow any amount of money, and that's where Tesla is, they borrow any amount of money. They just did another offering here very recently. He can fund any idea he has, and he flits seemingly from one idea to the next. And the problem is that he's primarily Tesla, a car company, and a car company is a very mature business, and it has huge players in it, and some of them are very great companies like Mercedes, and some of them make their cars for decades in Alabama, like Mercedes does, not in California as Tesla does. It appears that he's not able to produce cars at a profit. Right now he's losing $8,000 per minute, I think the number is. They're making parts by hand still. They're making batteries by hand, the reports of that. He really needs to be focusing, or at least have managers that are focusing on the very difficult task of making cars in an extremely competitive market where margins are low. Right now, he hasn't had to worry about margins. He has no margins. He has margins, but his profit margins are all in the red. And as long as the market's able to fund that, then he can keep flitting along, and that's been going on for several years. The problem would become if the market declines, as I expect it will, and the funding gets shut off, interest rates rise, then the party comes to an end.
Right. I want to get to that party-ending moment in a second. But Fred, first, do you have any views on resources or other limits imposing constraints that perhaps technology cannot overcome, at least not easily or without serious adjustments? Again, in the electric vehicle space, a lot of people, Fred, they approach me and they say, hey, Chris, your views on oil are a bit outdated. We're all moving to electric cars. And then I want to tell them about cobalt and lithium as limiting substances in this story. And do you ever run across that or look into those sorts of issues when you're analyzing these spaces?
I run across it, and of course, some of these items are in difficult areas to find, like the Congo, which isn't your best country to be doing business in. So yes, there are some limiting factors there as well, and it's going to take a long time for autonomous cars to become real, and electric cars, obviously electric cars, to become real. Those aren't my areas of expertise. I'm aware of them. I'm not investing in them. I can't get off in another area as it is. With the technology world, it's hard enough. So I don't have enough time in the day as it is right now. But I am aware of them, and I know it will slow things down. I also was aware that this whole electric vehicle and autonomous vehicle push will take quite a bit of time.
Well, indeed it will. And when I look at unit sales of internal combustion engines worldwide, standing at some 90 plus million, it's still obvious that the internal combustion engine is the dominant piece of equipment on the landscape at this point. And it would take quite a bit to unseat that.
Yeah, you're talking a fraction of 1% of vehicles right now that are electronic.
Yeah.
So, yeah. And that's not going to change. We're going to be dealing with that for a long time, many, many years.
Right. Now, to slip back into, you bought gold. You know, the first gold coin I bought was 2001. I was doing some research into Federal Reserve printing. Fred, I was horrified to discover they were printing upwards of $5 billion a month out of thin air. That was enough to worry me. I saw debts and deficits that were unpayable. They were quaint by today's standards. How do you make sense of? Let's turn now to what the central banks have done and are doing, and why that's such a source of concern for you.
Well, I beat you. I never invested in any kind of gold items, and my first purchase of gold coins was 1998. At that point, I had seen what they'd done with long-term capital management. They bailed them out. Seen what they had done with the Mexican crisis, bailed out. And so I started buying a few coins then. It wasn't much. I really started getting interested in after 2000 when they slammed rates down to 1%, and I knew then there was no stopping it. When you go down that road, there's no stopping it. Unless you have somebody who's going to be willing to take serious pain, and so far all we've ever done is push off that point of pain. So we had obviously the tech bubble crash. There was a reaction of slashing rates then. To 1%, that helped cause the housing bubble in mid 2000s, which then crashed, and then we had the credit crisis, and that led to a crash. And each time you've had to go to ever more extreme measures, and to the point where we then had to start printing money. And obviously, as you know, we went to QE1, and that wasn't enough. And when they slowed it down, they needed to go to QE2 because the market started to slip. And when QE2 ended, that market started to slip again, and they had to go to QE3, and that was infinite QE at that point. And then they stopped here and handed the baton off to others around the world, other central banks such as Japan and the ECB, and they went on to print even greater amounts in total, so that we reached a point of over $2 trillion run rate last year. And only this year now is the rate coming down. The Japanese are still printing, not as great a rate as they did. The ECB has cut their rate in half, and that will mean $700 billion less on the year probably, because they're supposed to end in September. And the U.S. is trying to taper with the QT, quantitative tapering as they call it, and they'll be reducing if they're able to get through it. I doubt they will, but their plan is to drop their balance sheet by $420 billion this year as they increase it quarter by quarter. 250 billion of that will be treasury reductions, and the rest will be the mortgages. So I don't think, and I've always believed this, that and Austrian economic theory tells you this, you have to keep doing more and more when you go down that path. And so they're not going to be doing more and more. And I think that was really the trigger to what we started to see in the last couple of weeks, which is the markets becoming very volatile and declining very sharply. So you can point to the 2.85% treasury 10-year treasury rate, which it went to, but I think it went to that rate because of the reductions by the Fed and the other central banks around the world at a time when deficits need to be funded, particularly in the U.S., where Trump came up with a $1.5 trillion tax cut and hundreds of billions of spending initiatives. At the same time that they're doing $400+ billion of QT. I saw J.P. Morgan estimated that the Treasury will have to borrow almost $1.5 trillion this year. They only had to borrow $500 billion last year, so that's 3 times. And I'm not sure where you get that money when the Japanese and Chinese, who are the number 1 and 2 buyers outside of the U.S., when they already have started to cut back on their buying, as they have been doing in the last several months. So what has to happen is rates rise. When you have the kind of debt levels that we have in this country and the world, 65 trillion or so in the U.S., 230 trillion according to the Institute of International Finance in total overseas, and you're looking at that, which is up 55% from the global financial crisis. So what the central banks tried to do was they lowered rates and tried to eliminate a debt crisis with more debt. That's not going to work, and I think we've seen the first crack in the market as a result of that.
Yeah, so in my world, the diagnosis was too much debt and the prescription was more debt. We've tried this several times. My sense is of a monetary policy that's in a dangerous skid. Bernanke oversteered into the first part of the skid. Bernanke continued that, really oversteered. We have Yellen oversteering. This is, in my view, the mother of all bubbles. Fred, in the prior 2 bubbles, and by the way, I'm only 55. I don't think anybody should live through 3 bubbles in their lifetime, but here we are. In the prior 2 bubbles, you could still find undervalued areas outside of commodities, outside of things like gold. I can't find any undervalued areas right now.
Well, I can find one area, gold miners, but gold miners are terrifically undervalued, and we can get into that later. But in 2000, it was really concentrated in the tech bubble.
Right.
The rest of the market was much of it was either fairly valued or undervalued. All of the attention went to the tech and the TMT stocks, as they call them, and the rest of the market was left begging. At that time, I was hiding. I only had a small percentage of my money in put options, and I was funding them with 6% short-term 3-month Treasury bills. So, there were plenty of places to be back at that point. This, some people call it now, is the everything bubble, because we have a great big bond bubble, as well as a stock bubble, as well as an art bubble, as almost every asset you can think of out there. They're all at inflated prices, and of course, that's what you would expect when you go on such a global money printing binge. Right.
Well, if we had the notion that from Buffett that you only find out who's been swimming naked after the tide goes out, this has been a tsunami. Nobody in alive has ever experienced any form of money printing like this. This is literally a sociological experiment as much as it is anything else, because we have wealth gaps, we have income gaps, we have all of that. So it's really been just rather extraordinary to watch. And I trust, Fred, more what people do than what they say. I'm looking at the Yardeni research here, which tracks central bank balance sheets pretty closely. I can't detect anything yet in that I would call tapering from the ECB or Japan. January is up. We're still at a run rate of $2 trillion year over year. That's down a little bit from about half a year ago, where we were at 2.5 trillion run rate. So think about that. These central banks last year were telling us everything's awesome. Unemployment's falling, the economy's improving, and they're printing the most money on a run rate that they've printed through the entire cycle. What do you make of that? What emergency are they fighting, do you think?
Well, they're very much aware of how dangerous the situation is. And that's why they're so careful to every once in a while. I mean, people thought when back in the mid-2000s when they were doing what they call baby steps, quarter-point hikes, because I remember, I'm sure you do, the Fed used to do 3-quarter-point hikes, 1-point hikes, surprise hikes, none of that. They have to have everything telegraphed in advance, and it has to be a quarter-point every once in a while here if they can. They're doing what they can to hopefully get themselves in a position where they'll have a little bit of a wherewithal to address the next decline. But it's ever so gingerly, because they know what the mess that they've created. They do, and it's. I mean, look. As soon as they dropped QE1 and QE2, the markets didn't do so well. So they saw that happen, and so they're very gingerly doing this. And we haven't seen much, but because the Fed has only cut, I guess it's $40 billion off of their $4.5 trillion. They haven't done much, and the ECB is still increasing, but it's certainly not increasing at the rate it was. And that's why I think the markets have trouble. I also think that's why they're not going to be able to go very far with the quantitative tapering, or even the cutbacks elsewhere, because the markets will shudder and shake and decline. And when there's enough blood on the streets, they'll be back again with another round of even more powerful. Initially, not so, but they'll try something less. But for them to get the markets really going again, or holding them up, it'll take more. It always takes more.
So this model we have here is they'll have to continue doing what they're doing, as insane as that might be. So here's a question I get routinely from people, which is to say, well, what's to stop them from just printing more and more forever? Where does this actually end? And I'm looking now at a headline from the Wall Street Journal very recently. Came out, says, new worry for CEOs, rising costs from metals to meat. I think you pointed this one out as well on your Twitter feed. Yes. We will see inflation at some point. Is that the rate limiting step here, or is something else going to stop this?
Absolutely. Initially, this has happened before. If you get a big asset inflation, then that is inflation. It's limited. It doesn't go so much into the consumer's hands, because obviously the high end are the beneficiaries of the asset inflation. So if it's houses or real estate and stocks and bonds, well, only so many people in the country own those. And so you had this inflation, but we also had seen it in other areas. My healthcare premiums just went up 67% year over year after a similar increase the year before. That's not exactly deflationary, as people talk about. Tuitions, rents, these are all up. Now, what they hadn't seen was wage increases, and that has changed. So the most recent unemployment report, or employment report, however you want to put it, they saw a pretty big jump in the wages, and we've seen over the last year or so, state after state raising minimum wages to $15, $11, $12 over multiple years. Cities, we've seen with Walmarts and Targets and large employers all increasing their minimum wages to double digits. At some point, labor, they can't keep getting squeezed. The average American has seen their real disposable incomes decline as inflation has been pressing upon them. Now, the central banks have done everything they can through all the various measures of, not even central banks, but the governments themselves, of hedonic deflating, doing everything they can, stripping out spiky items. They have suppressed the real rate of interest in the CPI or the PCE, whatever you want to use. They've been suppressed. Certainly, when you have housing prices running at 6.5% and healthcare expenses and tuitions and all of that going up, the rate of inflation is not 1% like they've been telling us. But now with wage growth, then becomes a problem, because corporations have been running the highest profit margins in history. And you can't keep doing that in a market where prices are difficult to raise. So one of two things has to happen. When your cost of labor and your cost of materials are rising, you either raise prices as well, or your margins get cut, and obviously that means lower earnings. So it's a problem. So at some point, inflation was going to find its way to the consumer, and I think that's happening now. And it's one of the things that started to scare the markets.
Well, and this is part of the erosion of the social contract. Take one example. So the Bureau of Labor Statistics, most recently I was looking at new car prices, and they said, hey, since 1997, the average new car prices declined by 2%. Now, the average new car price was $17,000 in 1997. Today, it's well over $33,000. So it's nearly 100% increase in your out-of-pocket cash cost to buy a new vehicle. But according to our government, it's actually costing you 2% less. And the gap is all the hedonic improvements. And listen, are cars better? Sure.
You've gotten a better catalytic converter out of that, So, well, that's not as bad as the television market, where the government says that television prices are actually negative now.
Yeah, I get paid to buy one? That's amazing.
Yeah, negative. So that's how far they've gone with the hedonic deflating there.
Yeah, so it speaks to the trouble that the average consumer is experiencing. And of course, when the Federal Reserve dropped interest rates again, what we saw was a lot of private equity moving into markets and driving rents up extraordinarily. It's very difficult to get by. This is where I feel like I'm looking for the thing that's going to stop the central banks from just doing more of what they're doing, because what they've done is they've entrenched inequality. They've picked winners and losers. They don't create wealth, they redistribute wealth. And so in this story, when you look into how this printing story may end, how bad do you think it could get? What are you personally preparing for here?
Well, I've been very worried about as you said, the social contract fraying here. And you could see it everywhere. You could see it in the general elections, and even in the tenor of the discussion now. Trump rode to. I don't even know if he knew he was going to win at first. I don't think he did, but he was an outsider, and people were fed up, and so they voted him in despite all of his peccadillos, and they want change because they've been under financial stress for so long. I worry that we have all these entitlements that just seem to grow and grow, and we never address them. Trump was supposedly going to do that, and just in the last couple of weeks, Congress and Trump decided that they were going to drop any major push to cut back on the entitlement spending. We never seem to be able to do that, and that's taking up a bigger and bigger portion of the budget. And what I'm concerned at is that we have had a 9-year now long recovery, as subpar as it is, but it still is a recovery. And we're running deficits that are going to be back in the $1 trillion rates. But when we have an economic recession, and they usually come following bear markets, actually, and I think we're due for that as well. But when we get another recession, then the entitlements are going to spike again. Obviously your unemployment, your welfare, everything goes higher. Food stamps, everything goes higher. And if we were running at over $1 trillion already, we'll be closer to $2 trillion, and we're not going to be able to pay that at some point. Interest rates spike, we have to cut back, and all these people, you have a culture of dependency now for all these decades of time where they just keep growing and growing and growing. I mean, prior to the global financial crisis, we had 20-something million people on food stamps. Well, it went up to 48. It's not much less than that now. I shudder to think what it might be given another recession. So, obviously we have all these promises to retirees for Medicare and for Social Security that we won't be able to pay, and I don't know what kind of reaction we'll have there. It could obviously lead to trouble.
Fred, one of the more troubling charts I saw was that pensions, let's say like CalPERS, but generally pensions in the United States, they used to run a 60-40 portfolio, 60% bonds, 40% equities, and they flipped that in the last 10 years. Now the average pension out there is carrying a 60% exposure to equities, which in your mind, and mine as well, many others listening to this, are at some of their highest relative valuations they've ever been at. This yes. Too is just like another area where I struggle to understand how we got here.
It's unintended consequences of the central banks suppressing interest rates and printing money. When you don't have reasonable prices for your rates or yields, it forces these state pension funds and all of these people who are dependent upon bonds, in many cases, to get their returns, to have to reach for yield, and that's a very dangerous thing. And I mean, there's so many things that I think, when as you mentioned about with the tide going out, we'll find out later. Around the world, all these governments have been borrowing huge amounts of money at very low rates because they can, and there's been no pressure on them to control their spending whatsoever. And obviously, that's it's always fun to promise things to the general populace, but when the bill comes due, there's trouble. So we're not talking about just trouble in the U.S., we're talking about it globally, and it's all as a result of these, will be unintended consequences of these desperate attempts by the central banks to keep the game going.
Well, Fred, bubbles are always fun on the way up. Let's talk about on the way down. Corporate share buybacks, they've been a huge component of the earnings per share increases we've seen over the past 8 or 9 years. How do those work on the way back down?
Well, we know what happens. We saw they hit the absolute low in 2009. and they hit the absolute high right in 2007. So we know what happens; they'll go away. They always buy at the highest prices. They follow their peers. It's worked out very well for all of the executives right now because their bonuses are all higher, stock prices are higher, earnings are apparently higher. Although if you look at corporate tax receipts, they're all down because you don't pay money on EPS, you pay money on actual earnings. So yeah, we know what will happen. They will have all overpaid at these crazy prices. This is on a price to sales basis, this is the most expensive market in history, even after this recent decline that we've had. Some of the other measurements, either the second or third highest, and in those cases, the other comparative years were 1929 and 2000, and those two ended in terrific crashes. So we'll have a similar thing where markets decline a lot, and corporations will have wasted their cash at these very high levels, and then they won't be able to buy at the bottom.
And they may well be rolling over a lot of corporate debt at a time when interest rates are rising. And on that front, we see the Trump administration just put out a budget that projects nearly $6 trillion in total deficits over the next 5 years, and that's without a recession or any other sort of indicators that might come along and trash that number. What do you see interest rates just having, they have to go up from here with this kind of flood of money?
They're already rising. We know consumer debt has gone up well over $1 trillion, and the average rate on credit card debt is now up to 15%. We've seen the mortgage rates jump from what was in the threes now to 4.5%. Actually, Treasury bills, 10-year Treasury, have more than doubled here. So they've already gone up, and I think they have to continue to go up to be able to attract the kind of money to attract the money that's needed to pay for all of this debt. Like I saw somewhere where something like 20% of all of the debt in the U.S. is going to roll over in the next year or so. And those are going to roll over at higher rates, both for the government, the state and local governments, which are hugely in debt as well. Consumers, corporate, they're all at record amounts. Student loans, $1.5 trillion now from what was nothing. Huge amounts of debt, and even in this last fourth quarter where we saw a pickup in holiday spending, it was on the largest jump in consumer credit in history over 2 months. So rates will rise, and that obviously crimps everyone's ability to spend.
Wow, 20% rollover. Hey, turning very quickly now, quick question about cryptocurrencies, Bitcoin being the leading example presently. First, your thoughts on the cryptocurrencies as a store of value, and second, and maybe separate from that, your thoughts on the underlying technology.
Right. Okay. So as people have done, you have to separate the blockchain from the cryptocurrencies.
Yep.
The blockchain is a legitimate technology. It's an electronic ledger where you'll be able to store things independently instead of where we are right now. It's more efficient. A lot of people, banks, credit card companies, payment companies are all working on this, it'll be a change it'll be a plus for our future, I think, over time. The cryptocurrencies are what Charles Kindleberger of Mania's Panics and Crashes called delusive objects. They are of little value or no value. They are speculative objects that occur at manic tops. In 2000, we had dot-com companies that never had a prayer of making any money, and many of them never even had revenues. In addition to that, we had the Beanie Baby craze. These are your Beanie Babies. These are your dot-com companies with no revenues, no hope of them. Store of value, well, at first the argument was they were going to be used as a method of exchange. And we saw a few early adopters start to accept Bitcoin, retailers and that sort, and they basically all dropped them. Even the big online gaming place called Steam dropped it recently. There was a cryptocurrency conference in Miami in mid-January, and they stopped accepting Bitcoin. Why did they, as payment? Why did they do that? Well, because Bitcoin runs from 1,000 to 20,000 to 8,000, and that's a little bit difficult to deal with. In addition to that, the cost of transactions, of processing, are hugely expensive. So no one is using this as a method of exchange as was originally promoted. So when you talk about a store of value, well, We just saw 170 million stolen out of an Italian online nano cryptocurrency. We just saw 2 weeks prior to that 530 million out of Japan. Constant, huge thefts by hackers. That doesn't really lead to much confidence as a store of value for me. Running from, and Bitcoin is the largest, but it only accounts for a third of all the cryptocurrency values. And that one's the more tame of them, but that one went, from 1,000 a year ago to 20,000 to 8, as I said. That's not exactly your store of value either. And another problem is that stores of value are supposed to hold their value in times when the rest of the world's crazy, when markets are crazy, and gold has always done that. But that is not the case here. The cryptocurrency has gone up because they're delusive objects. As Kinderberger said, people gravitate to these things at the end just as speculative objects, away from originally what they were investing in, more valuable things, and then they crash. And right now, if you saw a chart, you probably have seen it. It shows the various stages of a mania, and it starts from not much interest, and it goes to a great delusion, and then to crashes and goes to despair. Well, that Bitcoin has been following that pattern almost to a T. So I don't see the value in them. I don't know what they're not. They have no intrinsic value whatsoever. Obviously, the precious metals have other uses. Gold is used in technology. Gold is used obviously as it's a very attractive thing. Always has been for thousands of years. It's used as jewelry. It has all sorts of uses. And there are no uses other than as a speculative object for cryptocurrency. So I expect they're going to continue to go down that path of to despair and collapse in total.
So let's talk then about an actual store of value. Gold, one of the reasons I invest in it is not because of its protection against inflation. It correlates poorly there. I do love it as a hedge against financial instability, institutional failure, maybe even sovereign decline, things like that. Tell us why what's really drawing you to gold here at this time, or what drew you, and then the gold mining stocks and how you separate those two.
Well, as I mentioned earlier, what drew me was the irresponsibility of the central banks as it appeared to unfold to me early 2000s, and they've only gotten more irresponsible as time has gone on. So I'm worried. Obviously, yes, as a store of value, it's always done that. Particularly in turbulent times, that's when gold does best. It also does best when the stock market's doing poorly. So in the 1970s was a pretty terrible period for the country and for the stock markets. We had big declines in markets and huge increases in inflation. And gold had a great big bull market. When the stock market turned around and we had a 20-year bull market in stocks that peaked in 2000, gold was in a bear market right along with it. It's a yin and yang, as I like to say. And so we had the lost decade for stocks in 2000s. And gold had a huge run from $250 or so to 1900 to the top. So we see this over and over again. It does well in times of difficulty, and we're in one of those times, or we're about to head into the most difficult of times, likely. And we have a stock market, a bull market that's very old, and an economic recovery that's very old, third longest in history, and things aren't good. And so I think that we're going to have another market decline that will take time, years, at least a couple of years, and gold should do very well during that period of time. In addition, it is again a hedge against inflation. We do have to worry about that. As we all know, gold has held its value over years. You can buy a suit, a toga suit in Rome for the same price you can buy good suits today. You can take that, food, whatever it is, it holds its value. Gold doesn't do anything. It holds its value over time, and the currencies decline against it. And that brings up the dollar, which is, if you look at the chart of the dollar, it's in free fall. It has broken through all support levels, and there's reasons for that. The reason is that it looks like the United States is going to go on a great big spending binge. And back in 2000, when gold was sitting there at $250 an ounce, we had surpluses from 1998 to 2001. And then we had 9/11 occur, and Bush went on a great big spending binge for, we'll say, some good reasons. But then they also continued. And then the Obama years were big spending years, and we saw budget deficits or budget surpluses go to massive increases. And we went to 8 to 10% as a percent of GDP, our debts. We went over $1 trillion per year, and 8 to 10%. And that just so happened to be coincidentally at the top in 2011. And in 2011, Congress initiated spending caps. And that just so happens to be the time when gold peaked. And it also is a time when the budget deficit or percentage of GDP started to fall rapidly. And it fell all the way down to 2.4% in 2015, which just so happens to be the bottom of what I think is the most recent cyclical bear market in gold. And now it's on the increase again, very dramatically. So if you follow the pattern, gold's going to rise as the deficits increase dramatically, as they did in the 2000s, and the dollar declines as well. Now, it also our trade deficits had been reduced, and we went down from 50 billion to 20-something billion dollars, and now we're back up to 54, a new high. So the trade deficits are rising. As trade deficit goes, so does the gold price of gold. So everything seems to be now pointing towards a big move in gold higher.
Yeah, part of my analysis, too, centers on the idea that there's not as much gold in the West as there used to be. There's been an extraordinary flood of gold from West to East, and as well, the gold miners are reporting more difficulty in reserve replacement, reserve discovery, and so we might actually see a decline in mining output. Is that the level at which you're analyzing this market as well?
There's no question about that. They haven't spent money on, they slashed their exploration and budgets because of the pressures they were under when gold fell in this most recent bear market. As a result of that, the forecasts are by everyone, whether it's sell-side brokerage houses or whether it's industry sources, are all saying that we're going to see year after year of declines in production going forward. And that's not going to turn around because it takes a decade or more to get a mine going. We've seen grades fall from what were 10 ounces per ton to, 10 grams per ton to 1 gram per ton on average. They haven't found an elephant find in decades now. It's just not, and when you do find them, it's often in geopolitically very difficult places. So yeah, there's no doubt that we are going to see a reduction in mining production, and we've already seen the peak, I think. Even China's numbers were down last year, their production, which is the largest producer in the world. We've already started to see that roll over, and that's only going to get more bigger deficits as we go forward. As you're right, there's been a huge shift. When the price of gold fell from 1900 down to its low of 1050, over these years we saw an explosion of buying from the East, led by China, which has now become the largest consumer of gold in the world. But Russia has been adding over 200 tons or more, 233 tons last year. Turkey, we've had this huge movement of gold out of Western vaults into Eastern vaults. The GLD is the great GLD ETF. There's not even close to the level that it once was at the top, and that gold has moved out, and it's not coming back. The Chinese do not sell their gold. The Bank of Russia does not sell their gold. It is not coming back, and we're not producing what we were. And that, when you have those kind of dynamics, it only leads to a higher price.
Now, Fred, I'm interested in directing people to your newsletter, and the High-Tech Strategist. Are you also analyzing individual gold shares and strategies in that?
Yes. It might not be every month. 2 months ago, I spent a lot of time on the miners themselves. Lots of times it'll be a lot of tech related, but it kind of all merged together. What's going on with the world and technology and the yin and yang on all of it, and the miners. But I've been personally heavily invested in the miners for many years, decade plus now, and I talk about the miners that I own, and it's an amazing story. What's happened to those stocks right now? You mentioned there was nothing undervalued, but those are. We have just this year we've seen price of gold hold up during this market decline, yet yet the miners get slaughtered to the point where what we look at is one of the things we look at is the Huey to gold ratio, or the gold miner index to gold, and that is down as of last weekend, or just 2 days ago, to 0.133. Now that is lower than it was at the 20-year bear market bottom in 2000. It was slightly lower than that at the end of 2015. But we're talking about near record lows here when the price of gold is up. I mean, it looks to me that gold is in a bull market. The charts look that way. It looks like we have higher highs and higher lows, and we've gone from 1050 to 1350 or 1330 right now. I think once we go over 1365, which is the old high in 2016, then more people will come on board, and we're likely to slingshot higher from there. But the miners have gone in the opposite direction. I think there's some reasons for that. One of which is that we've had a huge short position build up in the GDX ETF. Now, in the technology world, the Facebooks and Amazons and Netflixes and Googles of FANG stocks, they get propelled higher as the money pours into the ETFs. Well, it works the opposite way in the gold miner area where money has poured out. So in March of 2017, we had 510 million shares outstanding on the GDX. Just a week ago, it was 310 million, or a 40% decline.
Wow.
Now, a lot of that was short interest. I just found this out in the last couple of weeks. We went up to 55 million shorts on a 310 million now total, right? So that's almost 20% of the total shares outstanding in the GDX were short. Now that's like Tesla levels, one of the most favorite shorts on Wall Street. Now why would that ever be in a market where the gold looks to be in a new bull market? It certainly is up more than 20%, and the charts all look like it's in a new bull market. How could anyone put up these kinds of short interest? Well, it's one of the problems with the central bank is when you make money as cheap as you do, and you can borrow as much money as you want, then you can play games, and it becomes a giant casino. And the people who are playing this short game have helped to drive the price of the miners down at a time when people would have thought they would have risen. We've had this turbulence. The miners should have gone up. Gold held its own. It's up slightly on the year, but the miners are getting killed. And I mean, the owners can't get their head wrapped around it, and so they kind of get demoralized and then they sell out. And I think we saw that maybe on Friday. We saw a capitulative moment. And then what these shorts will do is that then they'll cover. Now, it's unfortunate that they get stampeded like this, but it's the kind of thing you can do when you have the ability to borrow at very low levels and to play games with people. They should be going higher. I mean, today we have the miners, they're down, pretty much down, or they're not down a lot, but they're down, but the price of gold's up another $6. You're only $30 away or so from a breakout high. Yet these miners continue to go down. They have rallied in the last couple of days, and I think that was the bottom on Friday. So you have this extremely low level. Ultimately, what determines the profitability for miners is the price of gold. So if you look back and see at the margins for these miners now, compare them to the bottom. Remember, we're back. These miners are right back to the lows almost. In 2000, at the end of 2015, they were only making $225 net of all-in sustaining costs. So the price of gold versus their all-in sustaining cost, and now it's double that. It's $460. Yet the miners haven't rallied. It's amazing. This is the same level almost that miners were, that $460 was $490 in 2012 when the GDX was not 21, or wherever it is at the moment. It's very close to that. Let me look. 21, but 45. So we have this huge disconnect between the price of gold, the margins of the miners, which are doing very well because they've had to keep their costs low, and the price of the stocks. Now, ultimately, that will get corrected, and we saw the huge run in 2015 where gold went up 30% in the beginning of 2016, and the miners went up 180%, and we saw that in 2000. when gold went up quite a bit, but the miners went up 1,600%. That's 17 times on average. We saw that in the 1970s coming out of the bear market there. We saw things go up on average, the ones I look back on, 1970s. We saw that on the big net miners went up at least 10%, 10 times, and some of them went up as much as 30 times. So we get this happens regularly where the miners get depressed, they get out of whack with the price of gold and margins, and then they slingshot higher, and that's, I think, where we're about. We're right there. And so I think there can be enormous amounts of money made, once again, just as we did in the early 2000s, just like we did coming out of in 2015, the bottom, just as we did coming out of the mid-70s mid-cycle correction, or even before that. So I'm pretty excited about it, and everyone else is completely despondent because they continue to go down while the price of gold goes up.
Well, and that's always the right time to buy, and that Huey gold ratio you just told me really is a real eyebrow raiser. And I will tell you, Fred, that I traded gold futures on an intraday basis, and I would never do that without having the miners on screen, because the games they were playing back in 2008 and 9 when I was doing this is I would watch the gold miners all get crushed as somebody came in, layered a bunch of shorts on. Then they would wander over to the futures market and do a dump there, and then reverse everything and take their winnings. So it's
especially
games.
with the volume as low as it is today. The volumes are very low because there's a little interest in them, and people their focus was all on the FANGs and the prices that only go higher forever, right? They'll never go down. So the volumes have dried up, and so it becomes even easier. The short interest ratio last week on the GDX went to 1.5. It's only happened one other time in the last 5.5 years. That happened to be July of last year, first week. And from that point forward, at that short interest ratio, the price of gold went up $120, and the miners went up 20-something% within a matter of weeks. So, that's how explosive it can be when you get to this point. And I think the shorts are about ready to cover.
All right. Well, from your lips to somebody's ears. Hey, Fred, thank you so much for your time today. Please tell all our interested listeners where they can follow your work and how they subscribe to your newsletter, please.
Well, I'm on Twitter, fhickey, HTS at fhickey. That's one way. And then we have the newsletter. I've been writing for 31 years. If you have any interest in subscribing to that, it's $140 a year by email and $150 by mail. And if you're interested, send us an email to the High-Tech Strategist at yahoo.com. And that's THEHIGH, strategist as it's spelled, at yahoo.com.
All right. Well, thank you very much for that. And we'll, of course, be putting that information at the bottom of the transcript and as well in the comments below so people can find that easily. Fred, thank you so much for your time today.
It was a pleasure.